If you feel confused by how a reverse mortgage works, I get it. This type of loan is totally unique and because of that, can be difficult to understand. What I found most helpful in understanding this product is to compare it to a traditional home loan. So let's start with a 30-year fixed mortgage. With this common type of loan, a homeowner will make equal payments for 360 consecutive months until the mortgage is paid down to $0. At the beginning of the month, you will have a mandatory payment of the interest that is accrued from the previous month, plus an amount that will go towards principal. The way in which the formula works for calculating the monthly payment will be made up of a large portion of interest in the first few years, leaving a relatively small portion of the initial payments actually going towards paying off the loan. As time goes on, since there is a smaller and smaller mortgage balance, there will be less interest due, causing a larger portion of each payment to go towards principal until the loan is eventually completely paid off. When you have a mortgage on your home, you're still the owner of your home, but the lender will have to be paid first before you receive any proceeds from the sale or refinance of your home. With this type of loan, you will usually have the option of including your property taxes and insurance in your monthly payment. Now, whether or not you decide to include these in your monthly payment, when your home is eventually paid off, you will always be required to pay property taxes. And as long as you'd like to keep your home insured, you will need to pay your homeowner's insurance on your own. Now let's look at a reverse mortgage. This loan will allow senior homeowners to completely eliminate their mortgage payment and/or access tax-free money from the equity of their home. So in the case of using a reverse mortgage to pay off an existing mortgage, all that happens is at the beginning of the month, when you would normally have a mandatory payment of principal and the interest that is accrued over the previous month, you will simply receive a statement that shows the interest that is accrued, but there is absolutely no mortgage payment due. No principal, no interest. As long as you're living in your home and taking care of the requirements we will discuss in a moment, there will never be a mortgage payment due on the loan for your entire lifetime. Now, before we get into who qualifies for a reverse mortgage, let's talk about what you're committing to when you utilize one. To start, you're required to pay property taxes and insurance, no different than a traditional mortgage. There will be closing costs to implement a reverse mortgage, and while these generally will not be out of pocket, these costs will be added to the loan balance. You must maintain your home. Now, this doesn't mean that normal wear and tear can't occur, but it does mean that something like broken windows or if a tree were to fall through one of the rooms of your home, you can just decide, well, I'm not going to use that wing of the home anymore. See, as long as you have this loan in place, your home cannot fall into disrepair. Now, a unique thing about having a home with a reverse mortgage is that it must be maintained as your primary residence. Now, there isn't a designated scout assigned to checking how many nights you're spending in your home, but there will be an annual occupancy statement that will be sent in the mail each year. This statement will ask if you're still maintaining your home as your primary residence and will ensure you have not spent more than 6 straight months out of your home and no more than 12 consecutive months in the case of a health emergency. Lastly, with a mortgage balance that is growing every month, there will be a larger and larger mortgage that must be paid off if you ever decide to sell. This will also impact the amount of proceeds that your heirs will inherit, specifically from the sale of your home. Now let's talk about who will qualify. For starters, at least one homeowner must be 62 years old, or in some cases as young as 55. You will qualify for a specific amount based on your age and the value of your home. This amount is called the principal limit, which means the maximum amount you qualify for. Assuming there are no optional payments made, the mortgage balance will grow each month. And since the interest rate will be applied to a larger and larger mortgage balance, the interest begins to compound, causing the loan to grow faster and faster as time goes on. See, this structure is the opposite, or the reverse, of how a traditional mortgage works. Hence the name reverse mortgage. So when does a reverse mortgage have to be paid back? So assuming the conditions we discussed earlier are taken care of, the loan will need to be paid back when you either sell your home or on the youngest borrower's 150th birthday. Now, in the case you don't live to 150, The heirs of the home will need to have the loan paid back through either refinancing or the sale of the home. Now, a benefit of this loan that protects the homeowner and the heirs is what is called the non-recourse feature. What this means is that no matter how large a reverse mortgage grows or how much home values were to drop, the homeowner or their estate will never be on the hook for any loss incurred by the lender. They would instead have the option of selling the home at 95% of the appraised value, or simply giving the lender the keys to the home and washing their hands of it while being free to use any remaining assets as they please. If you would like to run the numbers on exactly how this could look for you or a family member, drop a comment below or reach out to me at conversion.mortgage.